Hello, and a very warm welcome to this first Master Investor podcast of 2023, when we'll be discussing the themes that have emerged and those that have yet to make an appearance. My name is Sarah Lowther, and I'm delighted to be joined again by Jonathan Davis, author, investor, podcaster, editor of the Investment Trust's Handbook. Now, Jonathan, last time we spoke, it was very cold outside and we looked like a pair of Inuits dressed in our Arctic coats because it was brutal. It's still a bit chilly now, but I'm just wondering, have the equity markets thawed a little, do you reckon, 1 month into this year?
They definitely have thawed so far this year. Yes, they've been quite positive. We've seen some quite significant positive moves, and if you believe in the old market saying that, as goes January, so goes the year, then we should be in for a storming year this year. But I have to say, my personal view is that the jury is still very much out on that. Though there are some encouraging signs. If you follow technical indicators in the markets, which I do, they always help me just to keep a sort of handle on where we are. A lot of equity market indices have either approached or broken through their 200-day moving averages, which is a kind of common thing that many traders look at. And that's quite potentially a positive sign. So, yeah, things have definitely improved a little bit so far this year. But then, of course, last year was pretty horrible. So we're still a long way from making back what was lost over the course of 2022.
So one of the dominant themes of last year, which was a very unusual year, another unusual year, was inflation. Now, from my standpoint as a market trader, as in I sell cheese, I don't invest, but from my standpoint, selling cheese on the high street, I'm getting a sense from a consumer point of view that inflationary pressures are easing and it isn't going to be such a dominant theme this year.
Yes, well, that's certainly true. I mean, everybody expects inflation to come down. We've seen the peak of inflation, I think, almost certainly. Everybody seems to agree about that. Even the central banks who've been, trying to make us very scared about that. The real question, though, is how far and how fast inflation does come down, and that is, I think, a more nuanced argument because a lot depends on what you think is going to happen to interest rates and the economy. One sign is bond yields have been falling or trending down a little bit, certainly from their peaks back in the autumn. But that could be for two reasons. That could be either because the market is anticipating that inflation is going to come down quite sharply, or that they're just anticipating we're heading straight for a recession, and that is normally very bad for inflation. We might even get some deflation. So the argument is really all revolving around that, which is the greater threat now. No doubt inflation is coming down. The question is, will it come all the way back down to target, the central bank's target of 2%? Or will it stay at a somewhat higher level? And that, I think, will depend on whether we get a really bad recession or not.
So you talk about the central banks there. I understand that our Bank of England governor, Mr. Bailey, is having to eat humble pie because he was a bit too doom-mongery where his recessionary projections were concerned. And I understand that he's going to scale back his recession projections because it's not going to be as bad as originally anticipated.
Yeah, that's certainly true. I think the Bank of England this week will come out and reduce their assessment of how long the recession is likely to be. It's still going to be pretty long, according to them, but it may not be quite as deep either. But of course, central bankers are really in the business of expectations management as well as anything else. And so I think part of the idea behind the very gloomy statements that came out from Andrew Bailey and from other central bankers was to try and convince people that inflation was a serious problem and it would require some very harsh medicine. And therefore that, they hope, would help to moderate wage increases and so on, which is what their real concern is, I think, now of the Federal Reserve and the Bank of England. They're worried that rising wages will, because of unemployment is still to rise. They fear that will actually embed inflation into the system, even if we do see it come down, because people want continued labor will continue to ask for more money. That will beat inflation. We could have an inflationary problem coming that way. So they've been in the business of inflation expectation management. And as far as the financial markets are concerned, they seem to have been quite effective at that. Market implied interest rates 2 years out do suggest they'll get back to their inflationary target. Whether they've had the same impact on labour markets and people who are asking for pay rises, that remains to be seen.
So you talk about expectations management. I'm just thinking about the best way to manage our portfolios. There is so many podcasts devoted to active versus passive funds. So I'm just wondering which one you lean towards and which one would be worth a consideration in today's economic climate.
Well, that's a very good question, a very interesting question, I think, because it sort of speaks directly to the kind of short-term, long-term issue that most investors have. You know, every year you have to decide whether you're going to make some tactical moves because of the current market conditions, or whether you're going to stick to your long-term plan. Now, over the last 20 years, it has been a remarkable period for passively managed funds. Well, the last 30 years, to be honest, but mainly the last 20 years. The first index fund was only introduced for a couple of years in the 80s, but basically it's a phenomenon of the 21st century, and it has been extraordinary, the number of the growth of the passive industry, whether that's index funds or exchange traded funds, and they've taken an ever increasing share of the equity fund market, and they're well up to at least 30%, maybe 35%, maybe more. And that's before you start to include what are called closet trackers. These are actively managed funds that effectively don't deviate much from the market index. So that's been a real problem in the past. They've been charging actively managed fees for basically passive managed performance. So the question, though, is whether that has come to an end. It has been an extraordinary phenomenon. Not only have passive funds continued to take market share from actively managed funds, but they've continued to outperform active managers over a long period since the global financial crisis. The last year the majority of actively managed funds beat the S&P 500, for example, in the US, was back in 2009. So that was 12 years in a row. But last year, for the first time, actively managed funds did outperform. At least a narrow majority outperformed last year. Admittedly, they were still down a lot because the S&P 500 was down 20% or so, but they were only down 18%. But I mean, it's a small triumph for passive managers, for active managers, I beg your pardon. And the question is whether this is what we've seen with the big rise in interest rates, the change in style favored by the markets from growth to value and so on, whether that will now introduce a period of when active managers can outperform again, which they did in the early part of the 21st century, between 2000 and 2007 in particular, they did outperform. So in a number of years, not all every year. So yeah, it's a very interesting question. I think there's some good reason to think that actually this year might be one when actively managed funds do outperform, the majority of them. But the long-term numbers are very much against them. It's very, very hard to do that on a consistent basis.
So obviously we don't want any fund managers to lose their jobs, but it's always good to shine a light on those organisations that do it very well. Are you in a position where you can name some names and direct people towards those entities?
Well, that's okay. So that's an interesting one. I mean, as you know, I write a lot about investment trusts, and all investment trusts are actively managed. And that's one reason why there are fewer of them than there are open-ended funds, let alone tracker funds. They are, because if they don't outperform, they tend to disappear, unlike open-ended funds, which hang around, like a bad smell for a long time, even if they don't outperform. Well, who would I expect to do well this year? I mean, again, I think the way to approach this is to think about what I call core and satellite elements of your portfolio. So if you want, you want to have a core exposure to the US market, which is such a big part of the global equity market. And there in the US, an index fund is always a good option. There aren't many good actively managed funds that will do particularly well in the US market, never have been. So that would be one thing. But if you come back to the UK, I mean, if we are entering a period when actively managed funds do well, I again would emphasize the attractions of small cap fund managers, because these are the parts of the market that aren't as well researched. In the US, I think it's less than 5% of companies that are not followed by more than a couple of analysts, whereas in the UK, in the small cap area, it's almost half half the market is not followed by any professional analysts. So it's a much better hunting ground in theory for active fund managers. And certainly in the investment trust sector, for example, I would pick out names such as we're looking at Henderson Smaller Companies. So that's Janice Henderson, their manager. Another fund there is Henderson Opportunities Trust, managed by James Henderson, who's been doing that job for about 3 decades and has a good long-term track record. They've all been suffered in the last year, of course, as the market went down. I'd mention also Addition Investment Trust, which is a small self-managed trust, a very interesting one.
Sorry, Jonathan. Jonathan, you just broke up there. I didn't hear what you said, that last company name.
Okay, I'd also mention the Addition Investment Trust, which is a favorite of mine, and actually made a positive gain last year against the trend. And BlackRock Smaller Companies, another one which has got a long-term record. They always have to watch out for when managers change. And the final one that I think has got a good record is Aberdeen UK Smaller Companies Growth Trust. But there, the manager, Harry Nimmo, has just retired, the long-serving manager, Harry Nimmo, and he's been replaced by his colleague who's worked with him for a long time. I'm sure she'll do a great job. I just would like to see her performance for a couple of years before I get too excited about that one. But in the small cap space, those are all good companies. Montanaro has a couple of good trusts as well. So I'd be looking in that sort of direction. That would be my kind of top tip for the if we are going to see an actively managed revival, shall we say.
Okay, and no disrespect to you, Jonathan, but I'm actually looking to go away, particularly as we're going to be getting this donut bomb of cold and snow coming our way in February. So last night I was watching television and it was the world's most secret hotels, and I was thinking, well, they were secret until this program, so now they're going to be the world's most popular hotels. But at the same time, Flybe has imploded again. So I'm just thinking, should I just stay at home? Holiday destinations, is this the time of year when we would get good deals, or should be thinking about escaping?
Yes, I think we should be thinking about escaping. I think, well, I certainly am anyway. I mean, I actually quite like the winter in the UK, but this one has been particularly cold and miserable, recently at least. And I think it is time to go venture abroad a bit further. I mean, it is true, I would pay a lot of money to avoid an airport. Let's put that way. I mean, airports are not great places at the best of times. And when you've got, we've got border staff on strike, and we may have other strikes in the aviation sector. I'm not wild about going to an airport, but I am very wild about I'm very keen on getting on Eurostar or going under the Channel Tunnel. You get good prices on those. I mean, Eurostar is only operating at 2/3 capacity, I think, because of various issues. And Europe, there's a lot of Europe to go and see. I think, and some, a lot depends on what happens to the pound this year. I think the pound is, well, we've got a slightly more sensible government now, and things seem to be not quite as bad as they were. So maybe the pound will do a little bit better this year. I'm not predicting that. But it certainly may do better against the dollar. So if you are going to get on a plane, I think this is the year to think about going, maybe thinking about going to back to the US. I mean, I have struck it off my list for the last 5 years because the dollar's been so strong. But I think I'm thinking about it this year. And that does mean getting on a plane, of course. But, that's maybe for that exceptional trip, I might do that.
There is, of course, the option of a cruise, but it would take you away from me for far too long. And of course, March the 18th, big plug here, Saturday, you and I are needed at the Master Investor Show at the in Islington. So wherever you're going, make sure that you're around on March the 18th. You hadn't forgotten, I hope.
I have definitely not forgotten that. No, absolutely not. I shall be there, and looking forward to it very much. I had a very good time last year. I really enjoyed it last year and met lots of people, including many of the subscribers to my podcast. Always nice to put a face to a name, or at least an email address. And that was a lot of fun. And yeah, it's going to be very interesting to see, because by March the 18th, we'll see whether this current rally in the stock markets, for example, has continued. We'll know if the central banks have started to slow their pace of interest rate increases, or maybe even talking about stopping them. That will be interesting to see. And of course, we'll listen to Jim Mellon every year. It's always interesting to hear what he's got to say. He did a pretty good call last year. If you remember what he was talking about, where you should put your money last year. That worked out pretty well over the course of the year, but he's been more optimistic recently. So I'm afraid March we're going to be here. But after that, well, who knows? Where are you going to go, Sarah? I mean, you say you don't want to go anywhere, but where would you go if you could? Or you would?
Well, so I normally go to the Isle of Mull. That's where I spent my childhood holidays. But then there was this children's program called Balamory, which introduced what was a very quiet island in Scotland to the masses, and now it's very touristy. So I would kind of like to go to the non-touristy part of there. Otherwise, I just like going up to Findhorn near Inverness, because my brother and my nephews and his partner live up there, and that's nice.
The thing that's always put me off about the West Coast is the horrible threat of midges, which I only read about. I have been to the West. I went to Stornoway once, but I haven't been to the West of Scotland very much. But the midges are, when are the midges out in force? That's sort of in the early summer, is it?
I think for the entire 12 months, but don't worry, because I'll make you some aromatherapy citronella juice that you can slather all over yourself so you won't be bitten by them. That's a promise, Jonathan. And with that, promise.
Midges or masses? I mean, what a thought. Anyway, but yeah, okay.
So I'll see.
I may not be ready for that, I may not be ready for slathering, as you say, but
with that, we will end this month's podcast. So that's January's podcast. I look forward to what we have to discuss next month. Jonathan, thank you.
A pleasure as always.